Well, terrific. Thanks very much. And it's a real pleasure to be here and speak to so many private investors in one opportunity. Now, being the keynote speaker at the Investment Company Showcase event sounds like it's very prestigious. I realise, however, I'm really just the buffer between the important sessions and the break. So I will try and keep it to time. I'm sure there's some hangry people in the room. Now, when I was asked a while ago to do this, I was asked, well, what might be an interesting topic to talk about? So I said, well, how about I do a session on how pointless it is calling views on markets, calling views on one market versus another, different industries, all of those kind of things, and how stock selection is the only way of doing it over the long term. They said, that's excellent. Yeah, do that session. By the way, can you do another session just before it, a panel? So I say, oh, no problem. While I'm here, I'll do a panel. What's that on? They said, we're going to ask you your views on markets, on sectors, and on styles and the like. So I've just done that session. I say that not just for a cheap gag, but also to explain my poor performance in the previous session, and we'll see where we go. But what I'm going to try and do in this session is really do exactly that. I'm going to try and talk about how difficult it is to make those calls and why stock selections, therefore, are probably the better way of doing it over the long term. That's not to say no one can make those calls, but we don't think we can particularly, and we don't think most investors can either. But what I'm also going to try and bring out is why we think now's an even harder time to do it than normal. We think that there's a lot more uncertainty today than there is typically. And perhaps to try and illustrate that and try and convince you at that point, I just thought about what's changed since I was just asked to do this session in the world. Well, we've had increasing tensions in the Middle East. We've had increasing tensions on US versus China. We've had a US presidential situation change quite dramatically with Biden dropping out, an assassination attempt on Trump. We've had lots of speculation about what's going to be in the budget, and just in the last few days, a Tory party leadership contest where the leader in each vote has changed every single time. So my argument is that there's a lot of uncertainty out there, whether you're looking domestically or whether you're looking out into the world. But perhaps rather than just listening to some chap rant about it on the stage, you prefer a chart. We all love charts, so I've got one here. So what I've got here is a chart of the well-known Global Economic Uncertainty Index. Now, there may be some of you in the room that have never heard of the Global Economic Uncertainty Index until now. Well, welcome to the club. I had to look it up. What it is an index that takes a bit of AI and says how much can I find in newspaper articles around the world, it does it country by country, on uncertainty, what's going on economically that's uncertain, what's going on geopolitically that's uncertain, and it tracks how much that's been increasing or reducing over time and shows what some of those things are. So I've got that on a nice pretty chart. So what would you read from this? Well, the first thing to read from this is that there's always uncertainty, so you just jump from one crisis to a different crisis through time. But the second thing I'd say is that the number of those seems to kind of increased in recent times, you can see there. And so that index is higher than it has been on average over that last 25, 27 years, whatever it is that's plotted on here. So I do think there's a lot of uncertainty. So, of course, with that backdrop, it's not surprising that equities have had such a tough time. No, quite the opposite. Equities have gone on a massive march up, climbing that wall of worry constantly. Now, rather than proving that by showing the usual chart of how equities have performed and showing a line that's going up to the sky or showing returns of equities versus other asset classes, I thought I'd show one that's got triangles on it. So this chart, what it does is those triangles are how long there's been consecutive days where the market hasn't dropped much. So we've defined that as where you haven't had a 2% drop in the S&P 500. So how many days consecutively have there been of those? And so until very recently, it was a couple of weeks ago, if you remember the unwinding of the Japanese carry trade that made a lot of the press, there was a 2% fall in the S&P 500 on one day. We've had a rise since, obviously, but that was 356 trading days in a row that we hadn't had a 2% drop. That's the biggest triangle on this chart for almost 20 years. So we've had this geopolitical upheaval that's got worse and worse and worse, and yet equities have carried on their continual march. So why can that be possible? Well, let's have a look at this chart, which might be helpful for slightly explaining it. And the reality is that equities haven't actually done as well as you might think. It's just that they've been propped up by 7 companies that were large and are now very large. And they've continued to drive that market up and up and up. The Magnificent Seven, as they're talked about, all US mega cap tech companies. But to illustrate the extent of this, I put just the 3. So we've just taken the 3 largest in the world by market cap. So you've got NVIDIA, Apple, and Microsoft there. And we've shown that together, the market cap of just those 3 companies is now the same as the market cap of the entire stock markets of the UK, France, Germany, Canada, and Australia put together. An extraordinary statistic, 3 companies, all in the same sector, being bigger than all of those markets put together. So what? Apart from the obvious concentration issue, there's also the fact that, can you imagine what the financial press would say if the UK stock market fell 5–10% in a day? It would be carnage. Everyone would be panicking, hands wringing, what's going to happen? Is this the start of the end? That would be happening. That happens quite regularly with NVIDIA. So it's not just that we've got concentration with a small number of stocks, it's concentration with a small number of stocks that are very volatile. Another interesting stat that you might find amusing. So Warren Buffett, greatest investor of all time, arguably, he finally, very recently, grew Berkshire Hathaway to a $1 trillion company. It took just 66 years. NVIDIA added $1 trillion in 6 weeks. So, obvious question, is this a bubble? Sounds as though it is if you go through all those things. The problem is it's not actually like previous bubbles that we've seen. These are good companies. These are producing significant earnings. Just take 2023 alone. The average earnings growth from those Magnificent Seven companies was 21%. That's 3 times that of the rest of the S&P. And if you go back over a long period of time, the difference is quite extraordinary. So there's some good reason for why they've grown as large as they are. The key question, though, is whether that's more than compensated for in today's prices. And that's a difficult question. Maybe another way of looking at it, and don't worry if you can't read the names on here too much, I'll bring out what it says. This takes the concentration of the world index at the end of a number of decades. So we've got the 70s, the 80s, the 90s, the 2000s, and then we've compared that to the end of 2023. And there's a few things that you can bring out here. The first is that markets have always been quite concentrated to the top 10 stocks. The second is that actually in the 1970s, it was even more concentrated in the top 10 stocks than it is today. However, there's a couple of other things I'd bring out. The first is that what's quite extraordinary is that 8 of the 10 listed in 2023 are all in the same sector, really, whereas that wasn't true in the other decades. And the second is that if you look at the list of the top 10 names at the end of one decade, very rarely are many of them in the list at the top 10 names in the next decade. That's not because they've ceased to exist or they've absolutely crashed or anything like that. It's just generally that their market price got ahead of the fundamentals of the companies. Some of them still good companies, but just aren't the biggest anymore. So it'd be interesting to see where we are at the end of this decade. I suspect if history is anything to go by, a couple of those Magnificent Seven stocks will absolutely be in the top 10. but probably quite a few of them won't. I've spent a long time making that point, but really the conclusion is that it's stock selection that does matter over the long term. Maybe to ram that home a bit more, I've talked about the difficulty of calling markets at a top-down level. What about calling parts of markets within it? Maybe that's a bit easier. Well, I'd argue, no, it's not. So if we take the left-hand side, how many people would have guessed that growth would have outperformed value-type stocks by more than 50% over the last 5 years? You might look at that and say, well, it's obvious in hindsight. But actually, at the start of that 5 years, if you'd look back the previous 5 years, growth had trounced value. And everyone was saying, well, it's probably time for a reversal of that. There hasn't been. A lot of people got burnt with that trade. The next one, large cap, has outperformed the rest of the market by 30%. Now, admittedly, some of that is just down to those 7 stocks. But again, every piece of academic literature out there says over the long term, small cap outperforms large cap. Lots of people got burnt with that trade. And then on the right-hand side, if you're going to call sectors, yes, it might look obvious that now that technology was going to be a better sector than real estate, for example, over the last 5 years. But the difference between the two is astounding. That's nearly 200% return difference over 5 years between the best and the worst performing sector. You can make serious mistakes by making these calls, even over a 5-year period. And if you think calling countries is easier, think again. So here I've got the US, I've used the NASDAQ, that's the one going up. And China, the A shares market, that's the one going down. Again, at the start of this 5-year period, lots of people were talking about the US being overvalued. China maybe look quite attractive, but that has turned out to be quite dramatically wrong. Again, admittedly, if you take the 7 stocks out that we've talked about, the NASDAQ wouldn't look quite as extreme. But would you have called that and said, well, what I meant was the US X those magnificent 7? And where are we today? Who's going to call whether China looks attractive? We had last week a stimulus package by the government announced. China went up 35%. And then Monday, everyone went, actually, maybe it's not as big a package as we thought. It went down about 10, 15%. You literally got people day trading on whether they can call the extent of the stimulus package that the Chinese government are going to come out with. Now, I've got no idea what they're going to do, and I don't think many people have got that insight. Why are you trying to make those trades at a top-down perspective? So how can you make good long-term returns, both in absolute and relative perspective? Well, we think through long-term stock selection. So picking stocks that you've got really high conviction in, thinking about risk when picking those stocks in terms of permanent loss of capital rather than risk relative to a benchmark or relative to a peer group, and having the fortitude to own them for some time. As Sir John Templeton once said, if you want to get performance that's different to the market, you need to do things that's different to the market. So what I've got here is a chart that's an academic paper. It's a chart from an academic paper. Literally, I could find you hundreds of academic papers that show you the same thing. But this is a good one because it's got a nice chart. And as we said, we like nice charts. So what I've got here is we've taken all of the equity managers out there over a long period of time up until when this academic study was done. But we've done a more recent one that comes up with exactly the same results for the last 10, 20 years. But essentially, you take all of the managers that run equity portfolios, you say how much risk do they take relative to their benchmark, and we'll split them up into deciles. So on the right-hand side, you've got the ones, the 10% of funds that take the most risk relative to their benchmark. So think of people that are running really concentrated 10, 20 stock portfolios and kind of ignore the benchmark. Those are the ones on the right-hand side. And then on the far left-hand side, it's the ones that are very close to benchmark. Think closet index trackers. They're on the left-hand side. And what this says is that if you literally throw darts at people that run highly concentrated portfolios and don't take much notice of the benchmark, they outperform throwing darts at ones that are closet index trackers by more than 1% per annum over a long period of time. Concentrated managers do add value. So I posit that investing with those kind of managers makes a lot of sense. It's a great starting point for where you can invest. The problem is that it's still quite volatile. So the best performers one year are not necessarily the best performers thereafter. In the interest of loving charts, here's one on the right-hand side. And what we've done here is we've said, let's just take the far left-hand arrow. What that says is if you start with all of the managers that were upper quartile, so they're in the top 25% of performers over the last 3-year period. We've said, how many of those, what proportion of those are still top quartile, top 25% performers in the following 3-year period? It falls to about 30%. You can't easily see that, but it does. And then we say, okay, of those, how many are then still top performers in the following 3-year period? Falls to about 7 or 3%, I can't remember which, but small amounts. And then it goes pretty much to 0. Interestingly, as you go along the right-hand side, in more recent years, it's actually been almost impossible to be at the top in one 3-year period and top in the next 3-year period. So rather than 30%, you're getting down to about 3% after one new period of 3 years. So what's the conclusion? The conclusion is just every manager has quite a lot of style about what they do. They do well in certain types of environment. So even if you find one of those 20 stock portfolio managers that are incredibly well skilled and you know that they're going to outperform over the long term, what you are not going to have is them performing well over rolling 3-year periods, even rolling 5-year periods. There's going to be periods where they do very badly. So what? Well, for us, what this says is that you need to have a number of these managers. You might say, well, no, it's okay, I've got a long-term perspective, I could just ride that out. I can assure you, you won't. Human psyche doesn't allow you to do it. If a manager's doing incredibly badly, it's very, very difficult to either stick with them or just keep giving them more money. You start questioning whether you got it right in the first place. You come up with reasons why it's obvious now that they're not as good as they used to be because they've grown or they've done. Whatever it is, you will come up with reasons to force action. It's very, very difficult as a human. And that's this point that the journey in investing is almost as important as the destination. And so what you need to do is you need to blend a number of these managers together, and you need to regularly rebalance your weightings between them because you don't want one of their styles to completely bias it. So if you had a load of growth managers and a load of value managers, for example, all the growth managers outperform. If you're not rebalancing, you've now got a growth bias just at the time when growth's done incredibly well. So you have to be constantly doing that. But the problem is, in order to do that, and some of you may try and do that yourselves, the problem is trying to do that, you can't just do it from understanding their past performance. You have to really dig in and understand those managers. You need to meet with those managers regularly. You need to understand what's going on in their portfolios. What's their edge relative to the other managers that you've met with? What's the real style bias they've got in their portfolio? How do I know whether I should be rebalancing or not? Are their portfolios starting to look like some other portfolios? This is an enormous amount of work. And of course, if you're trying to do it yourself, you're then paying capital gains tax potentially if it's not in a wrapper on some of those sales. So there's all sorts of reasons why this is difficult. What we think makes sense is to have a multi-manager run by a professional outfit that's doing this on a daily basis, getting to meet with those managers. The problem is multi-manager often costs quite a lot of money. You get this double layer of fees. And let's not forget that fees make an enormous amount of difference. And I think people wildly underestimate this. So another chart. What we've got here is a 30-year period. And let's assume that you're going to get returns of about 7% per annum. That's kind of what equities have done over a very long period of time. So 7% per annum returns. What these lines show is what you would end up with, how much money you would end up with given the same starting point if you were paying 0 fees, if you were paying 0.5% per annum, 1% per annum, etc., up to 2% per annum. And you can see that it's absolutely enormous difference just from a difference in fees when you accumulate that over 30 years. So it is important to do this at low cost. Now that's exactly what we do at Alliance Trust for the last 7.5 years and now at Alliance Witan. We have a team of 100 plus researchers. We go out, we research all of the best managers in the world. We spend all our time with them in the whites of their eyes, talking to them about their portfolio, understanding what their edge is relative to the other thousands of managers that we've met with, understanding what risks they're running in their portfolio. We've built tools to understand the risks in the portfolio, how we can rebalance, what implications that has, how do we make sure stock selection is driving everything on a day-to-day basis. And then we also do that with the benefit of scale. So we advise lots of institutional investors to the tune of some $4 trillion. And we manage on a discretionary basis some $170 billion as well. So what? You might argue. Well, the so what is that we can therefore get these managers to give us incredibly good fee deals. And so you can end up with a situation where you can invest in Alliance Witan at a cost that is lower than you could invest in those managers directly. And for that, you're getting this professionalism of understanding who are the best stock pickers in the world, doing this rebalancing, really thinking about risk, and ensuring stock selection drives everything, something that you couldn't do yourself. So this is the kind of portfolio you end up with. And so this was the Alliance Trust portfolio prior to yesterday. And you can see there we've got 10 managers. An important point to note is these are not all managers that are well known in the UK retail space. In fact, you can't even get access to some of these people as a UK retail investor. But even the ones you can get access to, you can't get access to their best ideas only. So I said before, all of the statistics show that you really want to go with those people on the right-hand side of that chart that outperforms by 1% per annum, the ones that run really concentrated 10, 20 stock portfolios. Well, what we do is we go to the best stock pickers in the world, and we say, we don't want your standard product that people can get access to. We want you to just give us your best 10 to 20 stocks. That's it. Nothing else, no fillers. We'll worry about risk relative to benchmark and peer group in how we blend all of these managers together. You just worry about risk relative to permanent loss of capital. And then we scour the globe for who are those best stock pickers, regardless of whether they're known in the UK or not. And this is the kind of portfolio you end up with. And then, as was mentioned, with the merger with Witan that formally took place yesterday, such that we traded as Alliance Witan for the first time, we actually added one of their managers to the lineup. So we've now got 11 managers rather than 10. This is the manager for what it's worth, Jennison Associates. I'm not going to go through it. The point I'm going to make here is this is a highly style-biased manager. They're very growth-oriented. They're looking for the long-term growth winners of the future. Now, normally, if you added them to your portfolio, you've suddenly put in place a growth bias in your portfolio. Well, we spent a lot of time understanding how we're going to change the weightings to these 11 managers. So they're no longer the same weightings we had to the 10 that were there before. We haven't just put them in and then spread that around. We've actually thought quite carefully about how they fit into the portfolio. So finally, just on what's the point of this merger? We've been doing all of this as Alliance Trust for some time. Why did we need to get together with Witan? Well, first thing to say is it's a continuity of approach for Witan. They had a multi-manager approach that was quite similar in many ways. It's total continuity of approach for legacy Alliance Trust investors. But importantly, we can now do it at lower cost. I've talked about the impact of fees and how significant that can be. Well, now we're getting the OCR, the ongoing cost ratio of the trust, down even further through scale. As was mentioned, hopefully we'll get FTSE 100 inclusion at the next opportunity, which increases liquidity, opens it up to other investors who would only invest in large funds and the like, but potentially also brings the discount in. Already we're a lower discount than most of the sector, but that could happen even further. We're getting an increasing dividend through this process, and we've done it in a way where there's no NAV dilution for shareholders. But importantly, it's going to ultimately lead to a higher profile. We can spend more money on advertising and the like, and we can get invited to do keynote speeches at events like this. So, what's the summary? Well, the economic and market backdrop is highly uncertain. Always is, but particularly is today. Aggressive macro positioning or style bets can succeed, although rarely. Typically, they fail, and they can fail pretty dramatically on some of those charts that I showed before. Concentrated stock selection is the way forward, but that can be really volatile. So to us, the natural way forward is to hire these concentrated stock pickers, but put a number of them together and rebalance around that. And we think by doing that, Alliance Witan can be a core part of every retail investor's portfolio. At that point, I'll stop for questions.
So we have a question here in the front, and then there's a lady in the second row here as well, and then there's one at the back. Joe, there's a gentleman at the back there as well. Yeah.
Thank you, Mr. Baker, for a very interesting presentation. I'm a shareholder in Alliance Trust, and I ceased being a shareholder in Witan because I saw it underperforming about 5 or 6 years ago. My question is that looked at, from my point of view, I feel some concern that Alliance Trust may have merged itself with some poor-performing multi-managers on the Witan side. And I wonder if you could comment on the costs of and the degree of stock turn that you see happening as you integrate the two businesses together.
Sure. So, yes, so the first point is it's very much the same approach that will continue from the Alliance Trust side going forward. But you're right, there's obviously a change in the Witan portfolio coming across. To put this in perspective, Witan had 2 of the same managers. So Veritas and GQG on the emerging market side were both in both portfolios. So that just comes across no cost on those stocks coming across. We've kept Jennison, who is a manager that we've rated highly and are actually in some of our institutional portfolios anyway, so that was a pretty easy one. So those come across, there's no change in that portfolio. But the rest of the Witan portfolio does get changed to the combination of those 11 managers that we went through. We use BlackRock as a transition manager to keep the costs of that down to an absolute minimum. We used them when WTW took over Alliance Trust back in 2017. And we used them to move from the old ATI, the old Alliance Trust Investments, to this new approach with a multi-manager. And we managed to keep the costs incredibly low, like much less than 0.5%. It was way less than, it was about 0.1, 0.2%, something. I can't remember the exact numbers. And you can do that with a transition manager that works that through over a period of time to do those. But the important thing to note is even if there's going to be some cost of that, that's been more than covered to a certain extent by some of the contribution to costs that have happened in this, albeit we don't know for definite. We will see afterwards, and that will how much the cost is, but it's usually very low cost when you use a transition manager. Bear in mind, we haven't got lots of UK equities that we're trading that are at stamp duty and those kind of things. You can do these at pretty low cost, and BlackRock makes sure that you use all your crossing opportunities, etc., etc. So it will be done at low cost.
Very good, thank you. There's a lady in the second row here, yeah.
I wanted to ask you a question about one of your slides, please. It's the slide which was the Conviction in Equity Investing Journal of Portfolio Management, summer 2014. We're talking 10 years ago, so how accurate is that, bearing in mind all the churn and turbulence that you've had since 2014, please?
Sorry, which one was this? The one which was the academic... Oh, the academic paper. Yes, as I said, so that one went back a long period of time to the point of the academic paper, which was 2014. We've then done, I could have added another chart to the slides, but I recognise I'm already only got 2 minutes left. But that one does the same for the period since then, and you get exactly the same outcome.
Yeah. Gentleman at the back there.
I have been a shareholder of Alliance for several decades, but I have two questions. The first one is simple. Can you get too big? And the second question is, you mentioned the economic and market risk. You do not mention the geopolitical risk, which seems to appear as a phrase in most company reports. And do we know what was the difference in investment trusts in 1939, when British Investment Trust had survived the Wall Street crash, and 1946?
I might struggle to remember those years, but on the first one, can you get too big? Unequivocally, you can get too big as a single manager. That's the beauty of the multi-manager approach. Bear in mind, we're at 5 billion, but this is spread across 11 managers. And so that one, we are so far away from having an issue with capacity. These are generally mid and large cap stocks on a global basis. They're highly tradable. There's no issues with capacity in the Alliance Trust portfolio. But yes, if you had a single mid or small cap manager trying to run billions of pounds, that would be a big issue, and they do start to have that. One of the things we spend a lot of time on when researching our managers is how good have they been on capacity management. And that's more important for managers that have always made their outperformance in the past in the mid and small cap space rather than the large cap space. And so we spend a lot of time on exactly that. On the second question, I might have to take you up on discussing that afterwards.
We've got time for one more question. Joe at the back.
What's your view about adding unlisted stocks to your portfolios?
Well, I'm relatively ambivalent to the principle. I mean, I think there's good opportunities to add unlisted stocks to portfolios. One of the big advantages of a closed-ended fund is that you can put some less liquid things in there. With Alliance Trust, we've wanted to keep it clear that this is a listed equity piece. One of the traps you can fall into as a listed equity manager is to think, well, it'd be quite easy to do the same in the unlisted space. And it's actually a very different skill set. Now, that's not to say some people can't be skilled at both, but most people are not skilled at both. It tends to take very different skill sets in private equity than it does in public equity. So that's one thing to be wary of. But the other thing to be wary of is you do need a shareholder base that understands that. Because it will lead to more volatility. It can lead to issues around leverage in the portfolio. So it needs to be managed incredibly well. I think there are lots of dangers of just jumping to it and thinking, well, if I can cover the world and some of the most interesting companies are now staying private, why wouldn't I just allow myself to invest in some of those? I think it's dangerous if you jump into that. But I'm not against it in principle, but it's not something that we or the board think is needed in Alliance Trust at this stage.
And on that note, Craig, thank you very much for giving up your time, particularly at the moment when I know you've been so busy. So.